Something historic is happening right now, and almost nobody in the mainstream is telling you the full story. The US dollar, the backbone of the global economy for nearly a century, is being pushed to the breaking point. What was once the safest, most trusted currency on Earth is now being sacrificed in a desperate attempt to keep America's fragile economy afloat. In just the last few days, Jerome Powell has sent the strongest signal yet that the Federal Reserve is ready to slash borrowing costs, and fast. That single move could set off a chain reaction that shakes every corner of the world economy. Stocks are soaring, the greenback is slipping, gold is exploding, and foreign governments are quietly dumping US bonds at a pace we've never seen before. This isn't just about interest rates or Wall Street rallies. This is about the survival of the American financial system as we know it. Will the Fed's gamble buy more time, or will it destroy the very foundation of the dollar's reserve status? By the end of this video, you'll see why we may have already crossed an irreversible tipping point. Today we need to talk about the frightening state of the US dollar and why the storm we all feared may finally be here. Over the past few days, shocking signals have come straight from Jerome Powell. And what we're witnessing is not just another policy adjustment, it's the beginning of a fundamental turning point in the global financial order. America is facing a brutal choice. Either keep interest rates elevated and drive the economy into recession, or ease policy aggressively to prop it up and risk destroying the very currency that holds the whole house of cards together. Powell's recent words give us a clear direction of where things are headed. The Fed is preparing to loosen policy very soon, possibly as early as September. And that decision could unleash consequences far beyond Wall Street. It's not just about monetary adjustments. It's about the credibility of the dollar as the world's reserve currency, and whether investors, businesses, and governments around the world still have faith in it. Let's start with the dilemma. If the Fed keeps rates high, the American economy stalls. Borrowing becomes too expensive. Businesses scale back, layoffs rise, and households pull back on spending. But if the Fed lowers them, the debt pile explodes. Washington is already running massive deficits, and Scott Bessent and the administration keep borrowing more and more. Cheaper money would mean that while interest payments could temporarily stabilize, the dollar itself would weaken dramatically. It's a lose-lose situation, and Powell knows it. That's why his hint about imminent cuts should terrify anyone holding US bonds or stacks of cash. If you're sitting on Treasuries, the real return is about to get crushed. If you're holding dollars, the underlying value will continue to erode at an accelerating pace. The Fed may frame this as a way to stimulate growth, but the reality is far darker. Slashing rates isn't some miracle cure. Even if borrowing costs dropped back down to 1% tomorrow, Americans would still be paying the hidden tax of tariffs. Steel, aluminum, copper, consumer goods, practically everything is more expensive. The effective tariff burden today is roughly 15%. And rate cuts won't erase that. Companies are still paying more for inputs, and consumers are paying more for less. So when Powell talks about easing, understand the trade-off. Asset markets may surge, equities may boom, gold may keep climbing, but the currency itself will take another hit. And the cracks are already visible. Right after Powell's Jackson Hole remarks, the S&P 500 jumped 1.5%. At the same time, the dollar index slid nearly 1% against major currencies. Yields on the 2-year Treasury collapsed by more than 10 basis points in minutes. That's the market betting that the dollar's value is going to slide further. Now, let's ask the key question. Why would anyone hold US bonds right now? Investors buy bonds to secure stable returns. But if the Fed is about to flood the system with easy money, then the return in real terms becomes negligible or even negative. That undermines the whole point of Treasuries as the world's safe asset. A reserve currency is supposed to maintain stability. When it doesn't, global trust evaporates fast. The consequences are severe. Central banks around the world have already dumped nearly $50 billion in Treasuries in a single month. They're reducing exposure to dollar assets because the real value is being compromised. That's not speculation. It's happening in real time. Global investors are watching the U.S. loosen policy during a trade war while tariffs keep pushing prices higher, and they don't like what they see. Less demand for bonds means less demand for dollars, and that pushes the greenback's value down even further. The historical perspective makes this even starker. Over the last 100 years, the US dollar has lost roughly 95% of its value. Since the year 2000 alone, it's shed more than 40%. And by 2025, we're already closer to 43% or more. That's not your home, your food, or your stocks getting more valuable. It's simply the currency collapsing. The so-called dollar milkshake theory that once predicted the US would drain liquidity from the rest of the world has flipped into reverse. Instead of pulling capital in, America is bleeding it out. Now, defenders of this strategy will say lower rates will spur industries, boost exports, and create jobs. But there's a major problem with that story. US supply chains are outdated, tariffs are choking imports, and Trump cannot afford to spend trillions on overseas infrastructure to fix it. So what happens to the cheap money? It doesn't flow into factories. It flows into share repurchases. In 2025 alone, buybacks are projected to top $1.1 trillion. Companies like Apple, Alphabet, and major banks are at the front of the line. And while that pumps up stock prices and boosts earnings per share, it reveals the truth. U.S. corporations see no profitable avenues for real expansion. Building facilities in America is too costly, and building overseas risks punitive tariffs. So they're stuck in a loop. Take the easy money, retire shares, inflate the market, and delay the inevitable. But that delay is now dangerously short. Inequality is widening. Real wages are stagnant. Asset holders are getting richer, while everyone else pays the price of higher inflation. By the end of Trump's term, that divide may become explosive. Look at the debt market itself. U.S. interest payments hit $1.2 trillion over the past year, and analysts warn this could hit $1.4 trillion in 2026. The only way to prevent that spiral is to drive yields lower. For instance, the 5-year Treasury yield would need to fall below 3.1% to stabilize costs, but it sits closer to 3.8% today. That means a cut of at least 75 basis points is the bare minimum. Yet such a drastic move would hammer the dollar even more. It's a dangerous balancing act. Meanwhile, investors aren't waiting. Money is flowing out of U.S. assets and into alternatives. Chinese equities are drawing inflows. International bonds are more attractive. But the real winner is gold. The HSBC survey this year shows a massive shift among Chinese investors. A year ago, gold made up about 7% of their portfolios. Today, it's 15%. That's a staggering jump. Globally, allocations to bullion have doubled from around 5% to 11%, while cash holdings have been slashed by 40%. Investors are voting with their money. They don't trust paper assets anymore. And the results are obvious. Gold has surged from $2,600 to $3,400 an ounce this year, a 30% rally that has outpaced the S&P 500, Chinese equities, and almost every other asset class. This bull run isn't finished because the very conditions fueling it, rate cuts, debt expansion, and dollar weakness, are only intensifying. Now, rumors spread earlier this year that Trump was considering tariffs on bullion imports. At one point, there was speculation about a 39% tariff on gold coming into the U.S. that spooked markets. But in reality, no such tariff was ever enacted. Gold imports remain tariff-free, and that's critical, because as the dollar weakens, Americans can still buy gold without facing another artificial barrier. Trump backing off this move is actually bullish for gold demand inside the U.S. So here's the big picture. The dollar's strength is unraveling, the Fed is on the verge of easing aggressively, and foreign investors are dumping treasuries while piling into tangible assets. China, in particular, has been aggressively stockpiling bullion. Official holdings have risen from 2,000 tons to over 2,200 in just a few years, moving from 3% to nearly 7% of total reserves. By the end of Trump's term, that could reach double digits. The writing is on the wall. China isn't coming back to buy U.S. debt. That ship has sailed. We've reached the point of no return. The global financial order is shifting. Looser policy may buy the U.S. some time, but it comes at the expense of the dollar's credibility. And when the world loses faith in the reserve currency, alternatives rise quickly, whether it's gold, yuan-denominated bonds, or digital assets. The dark clouds are not just forming. They're already overhead. The September Fed meeting could be the trigger that accelerates everything. If Powell delivers the cuts the market expects, the dollar will weaken further, bullion will rally harder, and central banks will continue dumping treasuries. The fragile balance holding this system together is cracking. The question isn't whether the dollar will face pressure, It's whether it can survive as the cornerstone of global finance in its current form. For over a century, the dollar has been the anchor, but now that anchor is rusting. The decisions made in the next few months will determine if the dollar drifts into dangerous waters it cannot return from. So stay alert. Watch what Powell does in September, not what he says. Watch where global money flows, not what American officials insist. The world is moving into real assets, gold, commodities, and currencies that aren't tied to Washington's endless debt machine. This is the reality of 2025. The game has changed, and if history teaches us anything, it's that no empire and no currency lasts forever. The US dollar may still be king today, but the crown is slipping fast. The countdown has begun, and when the shift comes, it will be sudden, brutal, and irreversible. Stay safe, stay sharp, and prepare for what's ahead, because this story is far from over.